Hello and welcome to BA 642, Accounting and Finance for Logistics Professionals. As we have met each other already with our bios, I'm Mark Shaughnessy. I'm an associate professor at the Loeb Sullivan School of Business, International Business and Logistics at Maine Maritime Academy. And we're going to delve into accounting and finance in a way that to provide you, hopefully, with a basic knowledge um, of the field so that you can relate to the finance and accounting professionals that you'll deal with in your business career, and also use accounting and finance to solve problems within your own field of study and your field of work. So generalized course. Some of you have accounting and finance backgrounds, some of you don't. We're going to try to get you all up to speed. So for those of you who have some accounting and finance background, some of this may be review at the beginning. I think by the time we get towards the end of the course, you'll all be being challenged with new material. And for those of you who do have some background in accounting or finance, either educational or professional, a review is not a bad thing. Putting it in context, understanding how it all fits together is always a good thing. So while we're doing this, think about those Egyptian priests. They had the knowledge that they didn't share with their subjects, with the people, and they used that knowledge to enhance their own power. Whether you think that's true of the current accounting and specifically finance culture in the modern world, you might as well get the knowledge. It's there for the asking. It's nobody's hiding it in their temples. You can acquire it. Requires a little work, and hopefully will get you to some level of knowledge by the end of this course. So what's financial management? Well, it's a bunch of different things. And really, if you were finance or accounting majors, this course would be probably 5 courses. We're gonna tackle financial accounting, we're gonna tackle managerial accounting, and we're gonna tackle finance. And they're all interrelated but very different disciplines and very different subjects. And they have really different outcomes or different purposes. So we're gonna talk about those in this chapter and the next. Sort of actually probably the first 3 chapters. We're going to talk about setting the stage for getting more deeply involved later with each one of these subjects. So we're gonna go through the financial management structure here, and then we'll carry it a little bit more into a little bit more detail in the next couple of chapters, and then we'll delve into more detail as we go forward. So 2 components to financial management. There's the accounting component and there's the finance component. I'm going to define each of those and give you a basic overview of what each of those functions does. And under accounting, there are actually 2 pieces of accounting. There's financial accounting and managerial accounting, which are quite different. They're not really the same discipline at all. They just happen to use the same database, really. If we think in modern terms of big data or databases, financial accounting uses the database to do one thing, and managerial accounting uses a database to do something different. So pretty much click over that. I already talked about it. Finance, on the other hand, uses some of that accounting data, but really finance is about acquiring and disposing of firm resources. So every firm, profit, non-profit, whatever, has to have resources in order to function. And the finance function is to acquire sufficient resources to meet the needs of an organization in order for the organization to accomplish whatever it's set up to accomplish. So we think of finance as sort of this guru kind of thing. Really, it's just about getting what I need in order to accomplish whatever I want to accomplish. Financial accounting is a very formalized system to record a firm's financial history. And history is the operational word there. It's about the past. So financial accounting has lots of rules. It's very constrained by its rules, and um, by design, those rules are there so that you can use the output and rely on it. And generally, the people who use the output of financial accounting are people outside the firm. Insiders may use it a little bit, but primarily it's designed so that outsiders can monitor what the inside is doing. So financial accountants report that progress, or that history, I guess it's not really progress, that history to all the stakeholders. And they do that in the form of financial reports. So when you see a balance sheet or an income statement, that's the product of financial accounting. And balance sheets and income statements and other financial accounting documents, there's 4 required for in any set of financial statements, are designed so that I, as an outsider in an organization, can look at that organization and determine what it has done in the past. And I can also compare it to other organizations of a like kind to make decisions about granting credit, about investing, about it being employed by that organization, that sort of thing. So I can look at financial statements and understand something about their internal operations, their internal financial operations, from the outside. Managerial accounting is quite different. Managerial accounting takes that same internal accounting data and uses it to make decisions. So it looks forward, it's a decision-making process. How do I make decisions about the future using information from the present or the past? So it's forward-looking, and it's there. It doesn't make decisions, but it gives you information to help you make decisions. If you think about, should I build a new plant? Should I hire 10 new people? Should I build a new ship? Should I whatever? Those kinds of decisions are informed by managerial accounting processes. So is this more efficient? Is this a better investment? All of those kinds of things. Because every organization is constrained by resources, and you want to employ your resources in the most efficient manner. The resources that you control or have, employ them in the most efficient manner. And to do that, you have to have some method of measurement and some method of helping you make those decisions about resource employment. Obviously, when you're making things looking forward, you're not always right, but there are ways to do that. Financial accounting, on the other hand, looks backward and reports what's already happened. So may both be working with the same database, but they're doing real different things. Within an organization charts usually look like this. Under financial management, you have both accounting and finance. And under accounting, you have both financial accounting and managerial accounting. So you've got a structure there, a hierarchy there. So all of these things are financial management, but there are pieces, the accounting and finance functions are kind of different. And under accounting, you've got these 2 rather different disciplines and outputs based on the same set of data, but used differently. So finance, we're going to make decisions that affect the wealth of the firm's owners, and we'll do some later on. We'll do some projects where you actually can change the finance of a very simple example. You can change it around and see what it does to the wealth of the firm's owners. Leave the operations the same, leave the income generation the same from the operation, and change the finances, and you end up with some really different results. You can completely change the return to owners by changing the financial structure of an organization. And that's really what finance is about, finding the sweet spot, finding the best structure for a particular kind of organization and a particular kind of industry. So the primary goal of all financial management is maximization of profits. There may be other goals, there may be societal goals and so forth, but the primary goal is always maximization of profits. And you can maximize profits in lots of different ways. So you can set different kinds of goals in order to maximize profit. Here's a few of them, that's certainly not all of them. So you can maximize sales. So if you maximize what's called the top line, the revenue line, you may well maximize profits. You can try to maximize market share. So for those of you who don't know what market share is, it's the share of a particular market that my firm controls. So I saw some numbers the other day that Gillette controls 80% of the shaving razor blade market worldwide. So that's an 80% market share, really high market share. Not many firms have that kind of a market share. But that's a market share number, whereas General Motors controls, I don't know, 12 or 15% of the U.S. automobile market. So it's a really large firm, but not nearly as dominant a market share. If you go back 35 or 40 years, General Motors controlled 45% of the U.S. auto market. So their market share has declined pretty dramatically. So sometimes companies look to maximize market share because if you have a high market share, you have more control of the market that you're in, and you can probably charge higher prices and maximize profits in that manner. Maximize how fast sales are growing, minimize expenses. Most of you are in the logistics world. Minimization of expenses is a lot of times what logistics people do. They're there to reduce costs. They're not necessarily on the grow the top line side. They're on the shrink the expense line to maximize profits. You can optimize the use of your assets. So if you have an asset, a plant, or let's say a ship, optimizing the use of the ship would be making sure that it's sailing more than it's sitting at the dock or on mooring. Making sure that it's heavily utilized so that we're generating more revenue with that particular asset. And then minimizing capital costs, that means reducing interest rates or using less capital to produce the same amount of revenue. So those are the minimization of capital costs and the optimization of asset utilization are finance and accounting, things that finance and accounting really controls. If you're successful at profit maximization, you end up with a higher valuation for the firm. So a higher stock price for a private company or for a nonprofit company, you end up with more resources available for use in your nonprofit goals, or if you're for-profit, more resources available for distribution to owners or to reinvest in the organization. So that's sort of profit maximization is all about that. Ways you measure it, here's a few ratios, and we'll see lots later. These are just some that are used a lot in looking at profit maximization. So return on investment. So we look at net income divided by the amount of investment needed to get that return. So that's usually an internal measurement. I'm going to invest in a new barge. What's the return going to be to me? So that's a return on investment calculation. Return on equity. How much am I earning based on how much my owners have put into the business? So equity is the one of those financial words, one of those Egyptian words. Equity is the amount of resources that ownership has put into the firm. Return on assets. So what's my return on the assets that I am employing to generate income? And return on net assets, that's the return on assets minus the liabilities that I've used, the other people's money, the borrowed money that I've used to acquire those assets. So bunch of different measurements. We're not going to go too deeply with this. Is really just an overview, but measuring or looking at that kind of ratios is a key part of understanding financial outcomes. So financial management has two overriding goals. Organizational goals, which are the things that the organization is looking to accomplish. We just said we want to maximize profit or return. Okay, so profitability, but the other thing that we really have to do is make sure that we are viable, that we're going to be here next year or the year after or 5 years from now. So financial management, even though we go back here, goals of financial management, profit maximization is a goal. That goal may be in conflict with this other goal called viability. And generally it is. You can maximize profit by taking larger risks, but then you risk the long-term viability of the organization. So there's a conflict. There's always an intertwining conflict between the two goals. So return versus risk. Is a specific investment, is the reward that we're going to get enough to justify the risk involved? So should we build the new barge? What's the risk involved? The risk involved is, let's say it's a bulk carrier barge. The risk is that there's not enough demand to keep it fully utilized. If there's not enough demand to keep it fully utilized, then the investment will not be a long-term success. So we can look at it. If we keep it fully utilized, it's going to be a very good return, extremely good return. But if the utilization falls because of economic reasons, or there's a drought and there's no crops to move, so we're not moving any grain, or that kind of thing, or our competitors also build barges and we have too many barges out there, and so therefore our barge is underutilized. But those are the risk factors. So is the return high enough to justify the risk? So if it works, I'm going to get a huge return. Really, let's see if I can get that. I'm going to get a huge return. And if it doesn't work, I'm going to lose that return. So understanding that risk return equation is super important. There's generally a trade-off. The lower the risk, and any of you who've had economics understand this, the lower the risk, generally the lower the return. The higher the risk, the higher return, the return. So if I'm buying US 10-year treasury bills, so these are treasury securities, so I'm lending money to the US government on a 10-year bill, I'm probably currently making less than 2% on that investment, but it's extraordinarily low risk. The chances of the US government defaulting on that risk, on that loan, are quite small. So I'm going to get my capital back at the end of 10 years, and therefore I'm trading off that low risk for a low return, less than 2%. If I'm investing in real estate, let's say a new building in a big city, a high-rise building, I'm going to look for a lot higher return than that because the risk is much higher. The economy turns, all of a sudden I've only got 50% of my building rented. I'm probably going to lose it. I'm probably going to lose my entire investment. So I have a chance of losing my entire investment. So if the building's 80% full, I want to see a very high return. So instead of 2%, maybe 15%. So I'm looking at a significantly higher need for return because I'm taking a significantly higher risk. And that's always the trade-off. The trade-off between risk and return is the primary decision-making process when you're looking at long-term investments. Viability is basically can we stay alive, and how long can we stay alive? And we measure that two ways. We measure it in a short-term measure using something called liquidity, another jargon word here, and a long-term version of viability is solvency. So liquidity and solvency are the two measurements that we use for determining long-term and short-term survivability. So liquidity and solvency. Liquidity. So we basically measure liquidity by saying how much we have that's available to us in the form of cash or near cash in the near term, and how much are we going to have to pay out to our creditors, people that we owe money to, in the near term. And the near term for accounting purposes and finance purposes is defined as 12 months. So things are liquid if they're going to turn into cash within 12 months. So liquid assets, cash is obviously a liquid asset. Marketable securities that are going to turn into cash within 12 months are liquid. Inventories are liquid because they turn more than once a year, so they're going to hopefully they turn more than once a year in most organizations. Accounts receivable are liquid because that's money due from people that we've sold things to, and generally the terms on receivables are less than 1 year. So all of those things are liquid assets. And then liquid liabilities are very easy to define as things that are coming due, things that we have to pay within 12 months. So next month's rent is a liquid or near-term liability. Loans that we have to pay back within a year are near-term or liquid liabilities. So an organization that is liquid, and the definition is a little bit squishy, is viable in the near term. So if we have 1-to-1 ratio, so we have liquid assets are equal to liquid liabilities, that is, or to short-term assets are equal to short-term liabilities. That's a sort of a baseline. If it's less than 1, you're pretty illiquid. If it's more than 1, you're liquid. But different industries have different measures as to liquidity because they have different reliability of revenue. So if you're in an industry where your revenue stream is very reliable, it doesn't change much, you can afford to be less liquid because you know that that money is coming in month after month, so you don't have to have a lot of reserve liquid assets. If you're in a very volatile industry with up and down revenue streams, then you need to be more liquid. You need to have more liquid assets to cover those ups and downs. Solvency is the other measure. Solvency looks at long-term ability to pay, ability to survive. To be truly viable, you need to have both liquidity and solvency. So the solvency stuff we'll talk about in much more detail later, but solvency is I have long-term and short-term liabilities that I have to pay. How well structured am I to be able to pay those off in the long term? So that's a solvency measure. So you've got this viability versus profitability, you've got liquidity versus solvency. I can make myself more liquid by making myself less solvent. Wait a minute, how does that work? Well, if I borrow money long term, what do I get? I get cash. Cash is liquid, but now I have a long-term liability, so I'm less solvent. So if I borrow money, let's say I borrow money that's not due for 5 years, I have a 5-year note, 5-year bond, something like that. I'm now less solvent because I have long-term liability, but I'm more liquid because I have current cash. So I've just moved the equation from liquidity to solvency. So the liquidity solvency equation is sort of one or the other kind of thing. You can move back and forth between one and the other, and you can move from being viable to being much higher risk and more profitable, but with much higher risk, so less viable. So those two things are always in conflict, and financial people have to deal with those conflicts all the time. And it's really about getting the golden mean, where I'm comfortable with my profitability, I'm comfortable with my risk. So that's kind of the hard thing to do. How do I balance viability and profitability? How do I balance liquidity and solvency? So is maximization of viability a good strategy? Generally, no. A fully maximized viable strategy means I have cash and that's it. I'm totally viable. I'm not going anywhere, but I'm not going to earn anything either. Cash doesn't earn much, if anything at all. So I can be totally viable, but that's probably not a good strategy. I don't have any earning assets. All I've got is cash. So the more you have liquidity and or solvency, generally speaking, you have lower profit and lower risk. The less liquidity and solvency, the higher profit and the higher risk. It's a trade-off between the two. And that's a misspelling right there. So since viability doesn't equal profitability, what does that mean? Well, I can be profitable and fail. So I can be profitable consistently and fail. Companies that grow very rapidly need resources. Those resources they have to obtain from outside the firm. They either have to get more equity or they have to borrow more. The faster they grow, the more resources they need. They may be showing profitable returns, but not be viable, not be able to pay their bills. So we're growing like Topsy, we're growing really fast, we're profitable, but we're not viable. We fail, even though we're profitable. And this happens with startups all the time. So we've got a good model. So think about a fast-growing company. Fast-growing company requires cash for inventory. The faster I grow, the more inventory I need. I need more productive capacity, plants. I may need more equipment, delivery equipment, warehouse equipment, and or manufacturing equipment. And the more I sell, the higher the level of the receivables that I have to carry. My customers, I'm selling them on credit, so my receivables go up, and I need to hire more people. So I'm growing, and all of these things need to be done before I get the revenues. So I have to have the inventory in order to sell it. I have to have the plants in order to build it. I have to have the staff in order to deliver it. So when you're growing, you're in a fast-growing company, you have to plan not just for revenue growth, but for liquidity and solvency. You have to have long-term plans for your cash needs. You have to be able to do cash flow projections, which you hopefully will learn how to do in this class. Because if you don't, you can be profitable, still run out of cash, and your creditors will shut you down or take you over. So those are important things to understand. So this is a real quick overview of the first chapter in the book. You know that for chapter 2, you're on your own there. That's the Excel chapter. I'm not going to teach you how to do Excel, but if you need a quick review, it's not a bad chapter to go through. Get you up to speed on some Excel basics. We will be using Excel a fair amount in the course, so please avail yourselves of chapter 2 if you need it. Following this lecture, there are a few short questions, lecture review questions. Those who've had courses with me before should be familiar with this. They are not for credit. I'm not going to give you bad marks or good marks on this. I will read them, and if I see anything that you don't understand, I'll comment on it, so you'll get a comment back from me. If you're answering the questions correctly, you won't get comments. I use this method because I can't see your eyes. I can't tell when you're glazing over. I don't really know if you're understanding what I'm talking about. So if I ask you a few questions about things and see your answers, I have a better sense of your understanding. So after every lecture, there will be lecture review questions that you have to answer before you go on to the next task within the module. So please answer those, and we will continue going forward. Thanks.